home loan interest rates have shot up post the RBI repo rate hike. This is a cause of concern among not only the existing home loan customers who have to now pay more through EMIs every month, but also among interested customers intending to take a loan for buying their dream homes. Let us explore whether you should prepay your loan or continue the EMIs at higher interest rates. Debt is the biggest liability, and reeling under debt is equivalent to suffering from a prolonged financial burden. That's why it serves best to prepay some amount of the loan to reduce the effect of its burden. For example, a 75 lakh rupees loan taken for 30 years at 30% will require you to pay a monthly home loan EMI of 55,032 rupees. The total interest outgo would be 1,23,11,644 rupees, and repayment of the total loan amount would amount to 1,98,11,644 rupees. Now consider the option that you get the opportunity to prepay the loan amount. Take for example, you had sought a 30 lakh rupees loan at 8% interest for 30 years. Post 2 years of regular repayment, you earn a windfall of 5 lakh rupees through bonuses or business profits. You decide to prepay a part of the loan by putting in 5 lakh rupees after 2 years. You can always prepay a part of the loan, however small it may seem compared to the original loan taken. However, for this, you must have a lump sum idle amount that may not be equivalent to the remaining principal amount but is enough to relieve you of some burden of the debt sought. Prepaying this amount saves you 32 lakhs 8,146 rupees in interest and allows you to repay the entire loan amount 67 months before the due date. This way, you have 74 lakhs 79,668 rupees at the end of the 4th year that must be repaid. Again, assume that after 40 years post last prepayment, the business you were into yielded you 10 lakh rupees earnings that you would like to use to prepay the article. Prepaying 10 lakh rupees of the total amount due would save you 31 lakhs 99,451 rupee interest and reduce your loan tenure by another 72 months, that is, 6 years. There is a direct correlation between the amount you prepay and the time when you do it from your savings account. Prepaying a part of your loan relatively early during the loan tenure saves you a lot on the interest front by minimizing the interest outgo. Usually, banks do not allow their customers to start prepaying their loans during the first year of loan repayment. This means that you may have to wait for at least a year, after which you may repay the outstanding amount in part or entirety. When you prepay a part of your loan, ensure that you are putting in quite a good amount. Prepaying in small amounts does not do much good, especially when your bank may also levy prepayment charges, thus negating the effectiveness of prepaying the loan amount. As opposed to the myth that you can prepay the loan only once, you can prepay a part of your loan amount many times. This means that instead of collecting your earnings and collating your savings at any place to prepay only once, you can prepay a part of your loan every time you gain from your job or business. Many people utilize their earnings from selling stocks at high prices or profits from the business to seek respite from the liability of the loan. Though loan prepayment may not affect your credit score immediately, it helps you in effectively closing the loan on time or before time, thus shoring up your credit rating. There is an old saying, borrow as little as possible and repay as early as possible. Unfortunately, many millennials living in an era where everything is available on credit fail to realize how each liability impedes their financial goals and lessens their chances of creating their much desired corpus in the long run.